Hey, welcome everybody to Coffee with Chris. It's our third episode. Hopefully you're able to join us on our webinars last week. We had a lot of fun with Clint and Joel. We went over some
You gonna keep that in the script? I think you need to use that. Let's use that and roll with that one. That's a new word for the week, ladies and gentlemen. We're going to use Q-Fee.
Boo-boo.
Okay. So this is Josh and this is Dave, and I'm having coffee with them.
Coffee
What
with
question
Josh
do you
and
have
Dave.
this week, man?
So last week we talked about evaluations. We talked about the market being where it is, and we sounded pretty doom and gloom. We talked
Yeah, you
about
were depressing to talk to.
we talked about not being negative
Yeah.
for the next 12 years.
Yeah, like-
when you average it out.
I mean, it really made me want to cry.
So make us not cry this week when people think about the next 12 years being negative. So there's got to be a place in the market where we're going to look to make sure that we do our best to help people with that.
Well, that's right. There is. So there's two things about that makes me not want to cry. One, we're able to look at current figures like valuations,
Right.
and then look into history and see what happened in the 10 to 12 years after that time. So we've said this all year long, but we were saying this in 2019 as well, that the current charts, and anytime we look at charts, those are history.
Right.
Okay, and as Mark Twain said, history doesn't repeat itself, but it sure does rhyme. And I think that this time we're going to see something similar. So we're able to look at valuations today and line them up with a time in the past and go, okay, this gives us a lot of confidence of the predictive power of those valuations. Now, we got to understand something about valuations. They're not guarantees of the future. They don't tell us when something's going to happen. We're just able to compare it to the past and see a tendency of what does happen. So it does give us kind of this doom and gloom picture of the markets, okay? But it also tells us a little bit of what to expect in the market cycle. It tells us where we are in the business cycle. And just like we expected, we went through a recession this year. Now, what we didn't expect was a global pandemic, so it was this shocking, massive event here. But as we see that business cycle unfold, we will know where we will need to invest in the future. And so one of the things that we've been doing, Josh, is rebuilding our models or realigning our models, using our rules-based approach to realign our models so that we can flow a little more easily between equities, fixed income, and commodities. That there will be places to go earn a good return. Okay, let's say that equities defy history and they stay overvalued from now until the Lord comes
Extremely
back.
overvalued.
Extremely overvalued. And they never come back down. It is just like this new golden age of stocks that do nothing and go nowhere and stay really high overvalued. All right, I highly think that that's not going to happen, but let's say that does happen, where we can rotate, whether it's into stocks or fixed income, but we can add a commodity sleeve.
Right.
There will be places to go earn a return, and we'll be able to use the same charts and the same history and the same rules-based approach to evaluate where we need to rotate into. So it's not doom and gloom. Actually, there's a lot of it that I'm very optimistic about. That even if we did get a sell-off in stocks, we would get a much better re-entry point into those stock positions. This is a part of the market's life cycle. Just like the business as a cycle markets do, this is just a part of it. So there's an excitement to it of, hey, let's let it unfold and let's go. Let's unwind the market and let's get us a better entry point for our clients.
So even though over the next 12 years it doesn't look great in the traditional model, there's places for us to go find return.
Yeah, we're not running a traditional model. Hey, that's one thing I think is very important, is we're showing what the old traditional buy and hold 60-40 strategy looks like, and that's what the Husman firm was showing in that analysis. And that's not what we're running. So that doesn't scare me a bit. It just says, hey, this is what we can expect to happen.
So if our clients are watching the S&P 500, what you see on the news,
Yes.
it's probably not a good benchmark of what their account's doing.
No, it's never a good benchmark of what their account's doing. And actually, I don't think the S&P 500 should be a good benchmark of what any investor's doing. It should just give us an illustration of what 500 stocks in the market's doing.
Or 10.
Or 10, or 5, or 6. The FANGs.
Right.
Plus Tesla. Well, Tesla's not in it yet.
No,
they got booted, man. They didn't make it in. How
They're
about
not
that?
good enough for the club.
They're not good enough for the club. Right.
So if you missed our
Your hair's
quarterly,
messed up.
if you missed our quarterly market update this week, you missed the best life advice and investment advice that I've ever heard. I mean, to me, it was the best life advice and investment advice that I've ever heard in my entire life. And Clint Sorensen, our chief investment strategist, said this, that during the week, you should be listening and reading Warren Buffett, but during the weekend, you should be listening to Jimmy Buffett. And so I love that. I thought that was some of the greatest advice that I've heard. I actually do listen to Jimmy Buffett on the weekends, and I do listen to Warren Buffett on the week during the week. So I think it was great advice. So, but Chris, what should we as investors, or what should clients be looking to look at during the week as far as market technicals? Should they be, what should they be following now based on where we are in this market cycle?
Wow. Thanks for such an easy question again. You like to do that. So I don't think that anybody watching this really wants to nerd out as bad as we do. So I'm not going to answer as to what we read and what we watch. Too much. Really, if I'm a retiree, why do you want to watch the market on a daily basis anyway? Why do you want to watch it on a weekly basis? Well, many of our clients are going to remember Danny Matthews, one of the founders of the firm, longtime managing partner. He ran money for 20 plus years, probably 30 years. He ran money. I saw him at the golf course the other day. You know what he asked me? What's the market doing? He wasn't kidding. He didn't know. He's retired. He's not watching the market.
Right.
This man completely knows what he's talking about. He can pick it up. He's read everybody you just named, and he still listens to Jimmy Buffett. It's just not 7 days a week, probably. But he didn't watch it. And I think that should really be instructive to our retirees. You have hired us to watch it every day. One of us is going to stay up at night worrying about this. Both of us shouldn't stay up worrying about this.
Right.
So I don't think that unless you've got a mental system to where you're watching what the equity markets did, the fixed income markets did, what the volatility did, what the commodity markets did, and it means something to you, I really don't believe that you should be watching it that often.
Right.
There's no reason for you to. In all seriousness, there's no reason for you to. And I think that it caused a lot of our clients a lot of angst, or a lot of people in general. I mean, you think about it, you pull up the market on your phone right now, and we're going to see a bunch of red and green, okay?
Yep.
And if that doesn't tell you something about the movements of the markets, then why are you watching it? A lot of technology makes this so easy for us to get sucked in, and we get really myopic on what's the market doing today. And what the question should be is more of, is my financial plan helping me reach my financial goals? And am I walking in step with that fulfillment that the Lord has for our life? And how does my financial plan fit within that? That's something that you and I have talked a lot, is that fulfillment that we want people to have, that fulfillment by God's design, and that money's just a tool. Money's just a resource. And I think we make it so much the scoreboard, and technology makes it really easy for it to be the scoreboard.
Yeah.
And so my answer to your question for our audience is, a lot of times in this case, is I don't know that they should be reading a ton or watching a ton. But if they do want something, then this is why we do push out this event, and this is why we do answer some of the questions. And I think we should write that up. Hey, these are a few things we are watching. Here's a market commentary to read weekly, to read monthly, something along those lines. But to not get over fixated with the scoreboard of the market.
Yeah. So listen to Jimmy Buffett 7 days.
I think you need to listen to Jimmy Buffett, especially if you're retired. I mean, Danny looks like it's 1978. His hair's gotten long. I mean, I'm wondering if he shaves like once a month, maybe.
So,
I hope Matthew
Jimmy
sees
Buffett.
this. Jimmy Buffett,
Nice.
that's right.
Sounds good.
All right.
All right. Well, thank you for joining us for Coffee with Chris. And if you guys have any questions, just reach out to us, and we'll be glad to help.